again, in this unlikely scenario, but yet a possible scenario, you lose your job. And so you've not only lost your job, but also the stock market has dropped massively. So you've essentially had a double whammy. So I know this is unlikely to happen to you specifically, but it's a possibility. We've got to be real.
Hey guys.
Hey.
So we previously made a video sharing with you guys 10 top tips to build an emergency fund fast. We'll link to that video above and below for you to check out. For today's video though, we want to share with you where to keep or invest that emergency fund.
Yep, if you're loving the sound of today's video, guys, we'd love for you to hit that like button and give us a signal, show some love for the work that goes into our channel. For those who are new to our channel, my name's Ken.
And I'm Mary.
Of the Humble Penny and Financial Joy Academy. What we do on this channel is give you guys the tips, the insights, the practical hacks to help you take control, grow your money, and work towards a dream life of financial independence and money joy. Okay, so a bit of boring admin. We're going to be mentioning a bunch of companies and brands and things like that on this video as a way to illustrate a number of these places that we consider you should check out as a way to invest your emergency fund. Just saying that to say that this is by no means financial advice to you guys. So obviously do make sure you do your own research and seek your own personal advice before you go ahead and potentially invest your emergency fund. Okay, let's dive straight in. So first question, how much emergency fund should we have?
So we'd normally suggest between 3 to 6 months of your monthly expenses. However, as we've seen with the pandemic, there is a case for actually saving more, as we've seen a lot of people have been made redundant and have had the need to rely on their emergency fund. Now, we understand that everyone's situation is unique, and so we would suggest in that situation that you could save a smaller fixed amount of, say, maybe £1,000, particularly if you're currently paying off really expensive debt.
Yes.
Okay, so we've built up our emergency fund.
Yeah.
Should we actually invest our emergency fund?
The answer is that it depends, okay? So more generally speaking, you shouldn't really invest your emergency fund because it's there for emergencies. But there are circumstances in which you could actually invest your emergency fund. And this is dependent on your attitude to risk as well as your own personal circumstances. Now, let me explain both scenarios. And in the first scenario, where I'm saying you shouldn't really invest your emergency fund is, think of a random scenario whereby, you've got a job, everything is good, you've got your emergency fund and it's sitting in a bank account, you're thinking to yourself, nah, this is just wasting away. I want to go ahead and invest my money. Then you go ahead and invest that money and, it's doing well and life's good. But then let's just say the stock market has a massive crash and, following from that, let's just say something else happens and the economy takes a tank. And again, in this unlikely scenario, but yet a possible scenario, you lose your job. And so you've not only lost your job, but also the stock market has dropped massively. So you've essentially had a double whammy. So I know this is unlikely to happen to you specifically, but it's a possibility. We've got to be real. We can't just talk about investing in emergency fund without actually pointing out the key risks that are tied to it.
Absolutely.
But it's also worth mentioning that for some people, depending on their circumstances, for example, you might be somebody who has key insurance around different areas of your life. So you may have protected for that boiler potentially breaking down through some insurance, or for that potential leak you might have at home, or even for that potential breakdown that your car might have. You might have insurance for these various possibilities. In that case, you might be someone who might then say, well, actually, I'm happy leaving a certain amount of my money in cash and therefore taking a proportion of it to invest. Mary and I can relate to that scenario where in our home, we are mortgage free, for example. We're not particularly worried also about losing our jobs. This is our work. This is what we're doing right now, making these videos. And so in that scenario, we're very happy to kind of leave a bit of cash available for us in the case of emergencies by way of a fixed amount of money, and then look to actually explore investing the rest of it in some of these various areas that we're going to be speaking to you guys about today. So I say all that to say that this is why I said it depends, and you really have to think about your own personal circumstances, and please don't jump into investing your emergency fund just because you feel like you need to invest your money because everybody else is doing it. You need to really do what works for you specifically.
Okay, so now let's look at 5 places to invest your emergency fund. Now, there are 3 things that you ideally want when you're investing your emergency fund. Number 1, easy access. Number 2, low market risk. And number 3, interest or dividend bearing. Here are some examples that tick off 2 or 3 of those requirements.
Okay, so the very first one is NS&I premium bonds, okay? So this is not necessarily an investment, but it's more an opportunity for you to save your money and then potentially win some tax-free prizes. Now, this is not like playing a lottery, because some of you might be thinking like, hang on a sec, it's going to sound like I'm playing the lottery with my money. No, you're not. With the lottery, you play the lottery, your money disappears. You don't get that money back. But with these premium bonds, when you put your money or save your money by way of these premium bonds, your money is protected. You will most definitely get your money back whenever you want, okay? But you have the additional bonus of the potential to win some tax-free prizes. So here are the core benefits. Number 1 is that you have easy access to your money. You can take back your money whenever you want it. Second is that the prizes you can get are completely tax-free, and it's tax-free from income tax and capital gains tax. And the third is that you can get premium bonds for your children if they are below the age of 16. Now, up on the screen is a summary of a screenshot that I actually captured from the NS&I website themselves. So you can see there in the middle that they've told us some of the key numbers here. For example, what are the odds of winning? They've said they're 34,500 to 1 for every £1 bond. So essentially every pound you put into premium bonds buys you 1 bond. So by that illustration, the more money you put into premium bonds, the higher your chances of actually winning those tax-free prizes, okay? You're also told that the current interest rate offered is 1%. So note with this that you're not getting paid out interest like you might get it in a normal bank account. What you're really getting, essentially, they take all the interest and they pay them out in these prizes, these tax-free prizes. So you then have a chance of winning by putting your money into a premium bond. Again, we're told that the minimum to paying is £25 and the maximum to paying is £50,000. Again, your money is completely protected. You can take it back whenever you want. Essentially, save your money in there, and the more you save, the higher your chances of actually winning those tax-free prizes. And they've been very clear to tell us, again, at the bottom of that screenshot, this is great for you if you fancy winning tax-free prizes, you've got more than £25 or more to save, and you want to make the most of those tax-free savings. But again, another screenshot on the screen tells you this is not for you if you want a regular income, if you're looking for guaranteed returns, this is not for you, definitely not. And or if you're concerned about inflation, putting your money into premium bonds will not help you achieve returns that will beat inflation. So this is definitely worth pointing out. Then the final screenshot I want to show you guys is essentially the prize draw details. This gives us some estimates around how many people are likely to win at different prize draw levels, okay? And what their estimates are for upcoming prize draws. Again, I've just put this on the screen for you guys, so kind of feel free to pause and read a bit more about this. If you want to get involved with premium bonds, we'll put those details in the resource section of this video for you to head over, click through and do some more research.
Okay, so number 2 is a regular savings account. They are similar to a normal savings account, but require you to save a fixed amount each year. So what are the pros for a regular savings account? Well, pro number 1, you can earn a higher interest rate than other savings accounts. Deals are usually fixed for 1 year, but then they drop after that. You can open up more than 1 regular savings account, e.g. if you had more money to save, you can open up 2 or 3 more with the top providers and earn an interest across all of them.
So that sounds like a hack, basically.
Exactly.
Yeah.
If you're a basic tax rate payer, you can earn up to £1,000 in interest tax-free. And if you're a higher rate taxpayer, you can earn up to £500 in interest tax-free. You can get protections of the financial services compensation schemes up to £85,000. Now, there are some cons for you to bear in mind for regular savings accounts. So con number 1 is that there are limitations on withdrawals in that period. Number 2, you earn around half the headline interest rate, and this is because you are drip feeding your savings into the account instead of, say, a lump sum. And as a result, compounding interest does not work in your favour as much. Now, here are some examples we're going to put up on the screen, and for each one, we're going to share with you the annual equivalent rate and the withdrawal terms. Okay, so for existing customers, Cambridge Building Society are offering 5% AER, and they do offer withdrawals, but not within the fixed term. Okay, next example, as you can see up on the screen, NatWest are offering 3% AER, and for withdrawals, you can withdraw at any time. So the next two accounts that we're going to share is for anyone, i.e. you don't have to be an existing customer to have one of these accounts. So up on the screen, as you can see, Coventry Building Society are offering 1.05% AER. So not as much as the previous ones, but for withdrawals, you can withdraw your money at any time, but with 30 days penalty charge. Again, up on the screen is Leeds Building Society, where they're offering 1% AER, and you can withdraw up to 1 per calendar year.
Okay, so option number 3 is to invest in globally diversified index funds or ETFs. Now, I mentioned this one with slight caution, okay? Only invest your emergency fund in an index fund or an ETF if you will not have need for that money in the next 12 months, okay? So really have to stress that, because once your money goes into the stock market, you know, as much as it is globally diversified, which really reduces a lot of your specific risk, your money is still exposed to the stock market and it can go up or down in value, okay? So that's really worth highlighting. Essentially, your capital is at risk. Now, I could mention so many different index funds and ETFs here, but I want to just pick one for illustration purposes only. And the one I'm choosing is the Vanguard FTSE Global All Cap Index Fund Accumulation. Okay, I'll put this up on this screen for you to take a closer look at. The reason I've chosen this for illustration purposes is that your money gets diversified globally. You can see up on the screen that your money gets invested into around 7,180 stocks via this index fund. It's accumulating, which means that any dividends you receive will get reinvested automatically. You can see there's an ongoing charge for investing your money at 0.23% per annum. And then you can see at the very bottom of that screenshot that this fund at the objective session says that this index is comprised of large, mid-sized and small company shares in developed and emerging markets around the world. Okay, this is important because it means your money is spread not only globally, but it's spread across large, medium and small companies, as well as in developed and emerging markets. So giving you a really good mix of different company sizes in different parts of the world. Now, if you look again up on the screen is a region exposure. You can see there that 62.9% of your money will get invested in North America, 16.4% in Europe, and so on. And again, I've highlighted to you at the very bottom that around 60% of your money will be in the United States of America, and around 3.9% will be in the UK, and so on. And that list carries on. This essentially is giving us an indication of how global equities look, with around 60% in the United States, okay, and the UK only representing around 4% of global equities. Now, to share a bit more information about this particular fund, which again is not financial advice, again, it's just for illustration purposes only, I've looked at past performance, which is not an indicator of future performance, obviously, but it's good to look at, just kind of give you a sense of the returns, okay? You can see there that in the past, say in 2021, this fund in total return returned 18.95%, in 2020, 20.51%, and it carries on if you kind of keep looking backwards, okay? So this particular fund, or any fund like it, is more likely to help you beat inflation, okay? Although that's not really the primary goal of your emergency fund, it's really there for emergencies, but if you are somebody who wanted those returns, then a fund like this could potentially, keyword, help you achieve that outcome. And the final thing I want to highlight again up on the screen for you guys is what the fees look like for investing in a fund like this. I mentioned, you can see that the ongoing charge, the OCF of 0.23%, which is actually pretty low, but you can see there are no entry charges, no exit charges at Vanguard for this particular fund. But do note there's a requirement of a one-off initial payment of £500, or you can do a monthly direct debit of £100. Okay, if you're enjoying this video so far, quick pause just to say, we'd absolutely love it if you hit that subscribe button, people. Show some love for the work we put into our channel. By hitting that subscribe button and hitting the notifications bell, you'll get notified as soon as we publish more videos like this one, which you've enjoyed.
Next is a cash ISA. This is a savings account where you never pay tax on your interest. Everyone over the age of 16, which is currently £20,000. Okay, so let's talk about some of the pros of a cash ISA. By the way, an ISA, in case you don't know, is an individual savings account. So what are the pros? Some cash ISAs are flexible, which means that you can take money out of your ISA and replenish them at any time without it affecting your ISA limit for that year. Next is that they remain tax-free year after year. Finally, you can transfer your ISA to another provider to boost your rate. Okay, so now let's look at some of the cons. If you don't use your annual allowance by the end of the year, then you lose it. Next is that you can only pay into one cash ISA per year. Now, some providers allow you to split and pay into more than one cash ISA per year, provided 1, it is with the same provider, 2, that you stick to the overall allowance limit, and 3, these providers include NatWest, Nationwide, Post Office, etc. Okay, so here are some examples, and I'm going to first start with easy access cash ISAs, and I'm going to put them up on the screen for you to check it out. Okay, so Scottish Building Society, as you can see up on the screen, are offering 0.70% AER, and you can withdraw money unlimited anytime. Next up on the screen is Paragon, who are offering 0.65% AER. And says, as you can see, you can make withdrawals up to 3 times every 12 months without impacting your interest rate. Okay, now, so let's look at some examples of some fixed rate cash ISAs. Again, so up on the screen is Aldermore, who are offering 1-year fixed rate at 0.95%. You can withdraw your money from this tax year or previous tax years if you need to, subject, however, to a deduction of 90 days interest. Next example up on the screen is Kent Reliance. Now they're offering 0.94% AER, withdrawals and early closures subject to 90 days loss on interest.
All right, so number 5 is the easy access savings account. This is just like any other bank account, except you can save into it and you can withdraw from it whenever you want or wherever you want. Now, the interest rates you should expect from these savings accounts would be quite low relative to the others that we've mentioned on this video. So your money will not really grow as much. It will in nowhere come anywhere near trying to beat inflation. Now, according to the personal savings allowance, basic rate taxpayers can earn up to £1,000 in a year of interest tax-free, as Mary mentioned earlier, and higher rate taxpayers can earn up to £500 in a year. Now, to get started with an easy access savings account, we'd suggest checking out a suitable price comparison website just to compare the various savings rates to see what's best for you and compare that to what you could get with your existing bank. But again, as mentioned earlier, the benefit of an account like this is that it's there, you're not losing any bonuses, the rate you're getting is the rate you're getting, and on top of that, you can withdraw your money, your emergency fund, for your emergencies whenever you want. Guys, we really hope you've enjoyed this video today, exploring 5 best ways for you to invest your emergency fund. If you really enjoyed today's video, we'd love for you to share it with one other person who you think would take value from today's video. We'd love to hear from you guys in the comments. How exactly are you currently investing your emergency fund? Where is it sitting at this very moment? Jump in the comments and let us know.
Thank you guys so much for watching, and as always, in all things, be thankful and seek joy. Take care.
Take care, guys.
Bye.
Bye.